Hello and welcome back to the free smart money course of the Prop Firm Academy. I am Witty and I'm a Forex trader. I do teach Forex traders also how to navigate the markets and more or less achieve consistency. This is the part 3 of the free training series which I've been uploading on YouTube. If you're yet to see part 1 and 2, make sure to do that. Also, make sure to subscribe to my YouTube channel and join my Telegram channel where you get free trade updates, free trade signals, and the likes and tips to make you a better trader. And importantly, I do host the Part 2 Profits podcast, which is more or less a psychology session and also a session where I do share tips and tricks to help make your trading even much more better. So go ahead, join my Telegram channel. The link is just in the description box. And today we're talking about order flow, which is the part 3. Order flow basically answers the question you must have been asking from the first 2 videos. So in video 1, I showed you how to determine the trend. In video 2, I showed you how to determine when the trend continues or when the trend reverses. What order flow answers is how to determine when or at what point the trend is either going to reverse or likely continue. So it's more or less a level in the markets where you expect the current trend to hit and then continue. So you expect the market to retrace into using order flow. It should retrace into a particular order flow level and then continue the trend. Whereas if likely the market breaks that point and eventually then breaks market structure to give you a break of structure, then you know trend has changed. So order flow basically helps you mark out the zones where you can look out for entries, where you can look out for reversals, where you can look out for continuations. So that being said, let's see exactly what order flow means. So basically there are 2 major concepts behind order flow, and that's order blocks and breaker blocks. What exactly are this? So the bearish order block, basically we assume the trend is bearish. In a bearish trend, you look out for bearish order blocks, and the bearish order blocks in the bearish trend are actually the bullish candles. So if the market is making lower lows and lower highs, and then you see bullish candles within those lower lows and lower highs, you assume that those are bearish order blocks. So you expect the market to trade into them and continue selling. Whereas for a bullish order block, it's just the opposite. If the market is making higher highs and higher lows in an uptrend, you expect the market to trade into a bullish candle and continue the trend upward. So the bullish candles in a downtrend are the bearish order blocks. The bearish candles in an uptrend are the bullish order blocks. If the market is making lower lows, right, you are expected to be looking for bearish order blocks, which are the bullish candles. So you are marking bullish candles in a downtrend as the order blocks. The moment when there is a break of structure to the upside, the last bullish candle or the last bearish order block now becomes your bullish breaker block. So you expect price to likely trade into the bullish order block, which was the last bullish candle in this downtrend, which was a bearish order block as at when the trend was a downtrend. You expect the market to trade into that and continue upwards. Likewise, in the bearish case, the market had been making higher highs, higher lows. You had been marking the bearish candles as the bullish order blocks. The moment there is a bearish break of structure and you're expecting the trend to continue downwards, the last bullish candle, the last candle to take price, the last bearish candle, the last candle to take price down just before the break of structure now becomes your new bearish breaker block. It might take a while for you to really understand this concept, but let's get on the chart and see if we can put a little bit clarity to it. So this is the Euro USD chart, right? The daily time frame. We realize up to this point, price had been making higher highs and higher lows. And then from this point downwards, price just started nosediving to the downside. Now let's mark the other blocks, okay? So in this case now, since price is making higher highs and higher lows, we are marking the bearish candles as the bullish order block. So let's mark this was a bearish candle. And then you realize there was a break of structure right here. So after this break of structure happened, this bearish candle, which was the last bullish order block, now automatically becomes a breaker block. So this is an example of a breaker block, and you see how price came back, retested the breaker block, sold off, came back, retested it the second time, sold off. Now if we're going to mark out the bullish order blocks in this uptrend, what we are doing is basically marking out the bearish candles. This will be an order block. This will be an order block. This is order block. Order block. Order block. Order block. And likewise, in the downtrend, if we're marking this also, all the bullish candles become the order block in the downtrend, and you see how price respects them. Likewise, this bullish candle, order block. This is also an order block. And then if we're marking it up to this point, we keep seeing how price was testing other blocks. Order block. This bullish candle, order block. So you realize very well order blocks can be used as a point in your chart where you expect the retracement in a trend to actually end or continue. So this is another order block, and you can keep marking and seeing how this was another order block, price came in to respect it. This is another order block, price came in to respect it. And that is basically the concept of order blocks and breaker blocks. Let's switch to a lower time frame to see if we can even find more clarity. So for example, in this bullish scenario, there was a break of structure right here. After this break of structure, we now mark out the order block and the breaker block. So this right here is this becomes the breaker block because that was the last bullish candle before the break. Price did not retest that. However, price retested this order block right here, and then tested this order block. We tested this little order block, tested this order block. This was another order block. This is another order block. So in a bullish scenario, those are the order blocks, and in a bearish scenario, you just flip it the other way. The bullish candles become the order blocks, and whatever the time frame is, it still remains the same concept basically. Even on the 1 hour time frame, we see the same thing repeating itself. In this case, markets came to retest the breaker block, and then this is another 1 hour order block being tested. And even if you go down to the 1 minute chart, you keep seeing how markets retest order block, order block, order block, order block. So your job is basically to understand the trend in terms of market structure, and then look out for the right order block that price will likely react from, and that is the point where you then mark out as your point of interest, where you'll be looking out to take your trade. So basically, this is the concept, right? You expect in an uptrend market you make higher highs, higher lows, higher highs, higher lows, higher highs. In a downtrend, lower lows, lower highs, lower lows, lower highs. So typically, you expect market to retest an order block or a breaker block, then continue to buy. You expect markets to retest another block or a breaker block, continue the buy. And then when there's a break of structure, you expect market to retest either breaker block or other block likewise. In this case also, after the pullback, you expect market to retest other block and sell off. So that is basically the concept of order flow. It's basically you marking out the bullish candles in a downtrend as your bearish order blocks, and you're marking out the bearish candles in an uptrend as your bullish order blocks, and then you are expecting markets to pull back into those zones and continue the predominant trend unless you have a break of structure. And soon as you have a break of structure, you just flip it the other way and you continue trading in line with the market structure. However, understand one thing: market structure comes first, and then when you understand the current trend, you then look for order flow in line with the current market structure. In video 4, I'm going to show you how to refine your order blocks to know which order blocks price will likely retest and which ones will likely not be retested. Make sure to subscribe to my channel, join my Telegram channel likewise, and make sure to join me on the Path to Profits podcast every Monday, where we share tips and tricks to make you a more profitable trader. And if you're interested in the full course, go ahead, www.thePropFirm Academy, pick a package, join us. You get the mentorship, you get the course, you get free signals, and you get free trade ideas every month. And also look out for my weekly forecast. Interestingly, the weekly forecast will now become trade of the week instead. So what I intend doing for the week on the weekly forecast moving forward, I intend analyzing one particular pair every week and also stating out my supposed take profits. So till video 4, see you next time. Have a great day.